real estate is very tax advantaged as a default, even without going into advanced tax strategy. That amplifies it. The way I approach, and I say this to my clients too all the time, is the way I approach tax advisory, and I think the way everybody should approach tax advisory, is that it is an investment. You're looking to save either tax dollars or time, or both. That's what everybody chases. That's what everybody thinks about when they think of tax planning. But there is another path, and that's what we're going to talk about now, and that's generating tax-free income, wealth building, and tax-free income that doesn't increase your tax liability.
Welcome to Generational Wealth MD's podcast on financial freedom through investing in real estate. My name is Param. I'm a mom, radiologist, real estate investor, and mentor to others looking to start or scale their real estate portfolios. The goal of this podcast is to provide you with inspiration, strategies, and insight so that you can stop trading your time for money and live life on your terms. If you love the episode, don't forget to subscribe and leave a review. Let's get started. I'm super excited. I love talking about taxes. And Nick, I work with you so closely. I know you love it too. So very excited.
Of course.
Okay, guys, I know a lot of you are curious about how physicians are using real estate to pay $0 in taxes. And a lot of you are excited to learn about strategies that you can use before the end of the year to save dollars by, strategically reducing your taxes. I am excited to have Nick with me today. Nick leads Aiola CPA, which is a virtual CPA firm exclusively serving real estate investors. I've been working with Nick for 3 years now, I believe, Nick.
Yep.
They specialize in tax preparation, tax planning, and accounting. And the best part is that Nick also manages his own investment portfolio. He has long-term rentals, STRs. Last time we spoke, I know you do flips. And you also invest passively in syndications. So we're very excited to deep dive into the tax efficiencies of real estate investing for both passive and active investors. A large part of our community invests passively in syndications. And then we have so many people, physicians and others in our community who are active investors, long-term, short-term rentals, all of that. We also want to talk to you about the impact of elections on tax policy in real estate investing. And then we're hoping you can share with us some power tax strategies so that landlords can use them before the end of the year. All very exciting stuff. I have been tapping into these tax strategies for the last 3 years, significantly reducing my taxes. A lot of our students who've gone through the Creating Generational Freedom program, some of them have used, short-term rentals to reduce their taxes by, and there is a limit in terms of how much you can reduce your taxes every year, but they've gotten losses over $800,000 in a single year because of acquisitions, and then they obviously have to spread that out. So much you can do when you're tapping into these strategies. So I'm super excited to deep dive into it. For those of you who want to learn more about the coaching program, hop on to generationalwealthmd.com/waitlist, and you can learn more about the program. We typically only have doors open in the spring and summer. And I know a lot of you on here are looking at short-term rentals. Some of you are closing on them right now. Some of you are under contract. So that is super exciting. We will deep dive into some of those strategies. And I know a lot of you listening are investing passively in syndications with us, with other sponsors. We're going to be talking about both strategies that all of you can tap into. We always have passive syndication opportunities. If anyone is looking to tap into 60% bonus depreciation before the year ends, go on to gwcapital.com. We have a deal now in Houston. Excellent, 85% tax exemption day one. So really solid deals. Hop on a call with the team and you can learn more. But let's deep dive into the tax part now, Nick. I want to start off by talking about the tax efficiencies of real estate for passive investors, because everyone gets super excited when we start talking about real estate professional status, the tax STR, loophole. But before, I always tell people that, there's so many ways we make our income in real estate. You have cash flow, and initially I thought it was just cash flow, but you have market appreciation when you're using leverage. That becomes powerful. You have debt pay down, and then the tax part, the tax savings part. And what I hear from a lot of physicians is that, well, I'm not going to invest in short-term rentals, or I don't qualify. I don't think I work full-time and my spouse does, so we're not going to get real estate professional status. So does it really make sense for us? Or I don't think we're tapping into the tax efficiencies of real estate. So let's start there. For some, what are the tax efficiencies that real estate affords that all of us get to benefit from?
I love this topic. Yeah, and this is a great one and a great starting point because it really gives people clarity on how to think about tax planning and how to think about investing and how they work together, because they do work together. Real estate is very tax advantaged as a default, even without going into advanced tax strategy. That amplifies it. The way I approach, and I say this to my clients too all the time, is the way I approach tax advisory, and I think the way everybody should approach tax advisory is that it is an investment. You're looking to save either tax dollars or time or both, for the cost of bringing that onto your team. And the way that I approach that is really in two different ways. There's two paths of tax advisory. The first one, like Param said, it's the one everybody gets excited about: tax reduction, reducing your taxable income, reducing your tax liability, significantly reducing the amount you pay, or significantly increasing the amount you get back when you file your return. That's what everybody chases. That's what everybody thinks about when they think of tax planning. But there is another path, and that's what we're going to talk about now. And that's generating tax-free income, wealth building, and tax-free income that doesn't increase your tax liability. So, one hand, it reduces your tax liability, and you feel that, you see that on the return. On the other hand, if you have W-2 income or K-1 income or 1099 income and you're investing passively, it won't reduce your taxable income, but it will generate more income that you're earning and putting into your bank account. And that income is tax-free. And that's what makes real estate so great, is because it is so often tax advantaged when you hold it. Long-term rental real estate, short-term, mid-term, passive investments and syndications, those distributions are usually tax-free all the way up until exit. And even if there isn't an exit like a sale, there could be a refinance event that's tax-free to you too, because it's debt. There are plenty of ways for you to have tax-free influx of cash, and your tax liability stays right where it is, at the same place as if you didn't make the investment. So in the same kind of way, it achieves the same thing, in the sense that your effective tax rate on the amount of money you're earning is lowering. So they're both equally as important. They just look very different on the tax return, because that second path, that passive investing, is pretty much invisible on the tax return. But it doesn't mean you're not receiving that cash every month or however often you receive that. And then you have appreciation and favorable exit strategies, 1031 exchange to defer taxes, opportunity zones to defer taxes. These are all available to passive investors too. And even if you don't have a deferral strategy or a mitigation strategy, even if you sell rental property outright, you still benefit from long-term capital gains if you hold the property for more than a year, which is favorable tax rates. So just built into the tax code, real estate is advantaged, even if you do nothing other than purchase it and hold it.
Yeah. And it's so powerful that I remember doing a webinar for a group of physicians. And I mentioned that with my first property, I had, over the course of 5 years, I had 40,000 in tax-free cash flow. And then I did a cash out refinance. And this was a property I put 30,000 into initially, right, as a down payment. And I had another 50,000 in, in tax-free money, which I got because of the cash out refinance, which you just mentioned. And people said, well, but you can't do that as a passive investor, right? And like you said, that is afforded to all of us, even as passive investors. If you're investing in syndications, if you're investing passively in long-term rentals or midterm rentals, all of us get to benefit from that. And I think that's something we forget to look at. Nick, can we talk about, while we're on the passive side, right? When investors invest in syndications, again, bonus depreciation is something we take advantage of typically.
Sure.
Right now, because we're at 60% bonus depreciation for every 100K they invest in a syndication, they get about 40 to 50K in tax losses. Now, there are physicians who have other sources of passive income that, they can, and they're getting that from surgical centers and endoscopy
Surgery centers, right? Yeah, we see that all
sometimes
the time.
as short-term rentals. So can you, and then they're paying taxes on that at their marginal tax brackets. And these syndication losses they can use to offset other forms of passive income. So let's talk about mixing and matching, right? Because that's what you do when you say tax advisory. Now, like how you say advisory is opposed to planning, same thing. But how else have you helped passive investors kind of optimize taxes essentially, even though they're still on that passive side with syndications or long-term rentals?
Yeah, great question. And this is something that's so important, because we do have a lot of medical professionals and physician clients who do exactly that. They have fractional ownership in surgery centers, and it doesn't only have to be real estate. Any investment that you have equity ownership of that you don't materially participate in, which is the opposite line of thinking when you're talking about reps and material participation for short-term rentals. This is the opposite. If you don't materially participate in a business where you have an equity stake and a share of the income and profits, then that is a passive investment to you. It doesn't only have to be real estate. So you can have passive real estate losses from property you own directly, long-term, mid-term rentals, or syndications that create these losses like you're mentioning. If you invest X amount and you're expecting 40 to 50% of X as a loss, you can use that to invest any type of, to offset any type of passive income on your return. One point of confusion that we see as a common misconception is that like interest, dividends, and capital gains from the sale of stock or crypto or any marketable securities, while technically in theory that's passive because you're not earning it, it's not considered passive income for the tax code. It's considered portfolio income. So we're really talking about business or other investment income where you have equity ownership in an activity that you don't materially participate in. But any kind of passive income to you would qualify to be offset by passive real estate losses.
Yeah, awesome. Yeah. And then this applies to a lot of our coaching students who year two, they own a short-term rental. Year one, they're materially participating. They use the losses against W-2 income, but year two, they're generating significant passive income from that because they aren't materially participating. They can use syndication losses to mix and match there. So they're significantly reducing their taxable income over there. So lots of strategies. Guys, anyone interested in exploring our latest Houston opportunity, go on to gwcapital.com, book a call with the team. But this leads me into what I think a lot of people get very excited about. Let's talk about those advanced tax strategies now, right, Nick? This is what allows people to shelter, what is it in 2024, it's $625,000 of W-2 income that they could potentially shelter from taxes.
Even more, 646, I think, is the number for 2024. So yeah, right around 650,000 that you can shelter on your W-2.
Awesome. So let's talk about real estate professional status and the STR loophole now.
Of course. Yeah, these are the heavy hitters. And this is what we were talking about in the beginning, that first path of tax reduction. And reps and STR, the concept is the same in the fact that you're operating the business differently. You're spending more time in the business. And the goal of doing so is to be able to convert the activity from passive to non-passive, because that means you can use those losses to offset any type of income. And that non-passive classification, it applies to, like, so if you have that, if that's a short-term rental or a real estate professional, you can offset W-2 income. If you have K-1 income, 1099 income, Param, you were talking about that limit, that's called the excess business loss limit. So there is a limitation on how much W-2 income you can offset each year. If you're married filing jointly, that's 646. If you're single, it's a different amount, roughly half that. And that's how much you can offset against your W-2. However, if you're a partner and you receive K-1 income, or if you're self-employed and you receive 1099 income, that's considered business income, and there's no limit on how much you can offset against those two. So depending on how you receive...
Oh, I didn't know that.
Yeah, depending on how you receive your income, because as a partner, you own a share of a business, and as a 1099, you're self-employed. So W-2 is really the only... you're an employee of a company that you don't own, so it's not considered business income, but all business income together. And, like if you had, just quick numbers for an example, if you had 500K, let's use bigger numbers. That way we can introduce the limit. If you had 800K of a W-2 and you had 700,000 in real estate losses, using round numbers, 650 would be able to offset your W-2, and you'd have $50,000 excess carried over into the following year as a net operating loss. But if you had 800K in K-1 or 1099 income, you could take a full 700. Even if you had more losses, you can offset the entire 800 plus the 646 against possibly other W-2 income. So all business income goes into one pot, and whatever the result is, that's when you start to introduce the limit. Hopefully that makes sense. It's a bit complicated, but
that's actually amazing, because I know we've had couples in our coaching program where they purchased 2 short-term rentals, and I believe they own the practice, so they're probably getting a significant portion of that income as a distribution or as K-1 income, and so they had $800,000 in losses that they could use against their income. So I have a feeling they were tapping into more than just that.
Yeah, that would be great. there's strategy there. So a lot of medical professionals have S corps, and
Yes.
as an S corp, you're required to pay yourself salary. So depending on, you got to pay yourself a W-2 income. So you're every time you run payroll for yourself, you're taking away some business income and adding W-2 income. So there is
Yep.
strategy on how much to pay yourself and what entity structure is best for you and how that ties
Yeah.
into your real estate investments. It all goes together.
Okay, that's awesome. Now one of our members within the program. She was a radiologist, but she was a stay-at-home mom, and she purchased an apartment complex. She rehabbed it. She qualified as a real estate professional, and she was able to shelter over $500,000 of her spouse's clinical income from taxes. So let's talk about
Mhm.
the criteria someone needs to meet to even be able to do something like that. Let's talk about reps and maybe material participation a little bit.
Absolutely. Yeah. So reps is at its highest level of criteria. There's two main criteria, and that is you have to spend over 750 hours in the year on all real estate trades or businesses that you materially participate in. And the second one is over 50% of your time in real estate trades or businesses that you materially participate in. And that is an important end to the statement that you materially participate in, because it is an aggregation. So real estate trades or businesses includes long-term rentals, midterm rentals. If you're a real estate agent, if you're a property manager managing other people's properties, flips, developers, these are all real estate trades or businesses. So you could have, your hands in multiple buckets, and depending on how you split your time, you could be able, you may be able to add the hours from all of those businesses into the reps bucket.
Mhm.
But you have to materially participate in each separate business in order to count those hours spent to the total. So it is important. Like if you're a real estate agent, for example, or a property manager, you can't spend, like 20 hours a year on your long-term rentals and expect those to follow into the reps strategy. It wouldn't work. You still have to materially participate separately in each separate business. So 750 hours works out to be about 15 hours a week starting from January. And we like to have some cushion. So the real target you want to see is 800, 850. Because we've been through, when you're in an audit, they can strike out some hours and you don't want to be too close to that threshold. You want to have enough padding and level of comfort to be able to successfully defend in an audit. But those are the two main criteria. Below that, it gets a lot more complicated about material participation and which hours count and which hours don't count. And there's aggregation rules or elections rather, about grouping your properties together to make it easier to hit these criteria when you have a bigger portfolio.
Mhm.
So there's a lot of nuance, but at the highest level, that's the main criteria.
Yeah. Now, short-term rentals, and this is why it gets very exciting for physicians, because as a physician who's working full-time, or as a couple where both of you are working full-time, it's hard. You're not going to be able to meet criteria for real estate professional status because of
Mhm.
that more time in real estate than any other income-producing activity, right? So now that's why a lot of physicians, single physicians like investing in short-term rentals, because they can still go to work full-time, work overtime, and they can still meet criteria for material participation and
Mhm.
use the losses from that short-term rental against their active W-2 income.
Hey guys, I'm here in Dallas. I'm touring the next acquisition, the townhomes at Bluebonnet Trails. This is in a Dallas submarket, Waxahachie, within a 30-minute commute to downtown Dallas. Dallas is seeing the strongest migration in the country. These are luxury townhome style units. You can see them in the background, and they have a very affluent tenant base. These were built in two phases between 2020 and 2021. This is a core asset, which means it's significantly lower risk. The rents are about $2,700 right now. There is a gap, loss to lease, where we can bump up rents by another 200 easily. Occupancy is already super high at 96%. We're going to see longer, very stable, very affluent tenants in this property, which makes it low risk. We have a conservative debt structure, which is about 5.2% agency debt with projected 20% average annualized returns, and about 6 to 10% cash flow, which is typically what we see with deals that are core assets.
So let's talk a little bit about that criteria, because now they're not hitting they're not hitting real estate professional status criteria. All they need to do is hit criteria for material participation. So how does that work, Nick?
Yeah, the criteria for short-term rentals and material participation is much more attainable than reps. You can do this with a full-time job. I've done this myself, running a CPA practice and still able to do a short-term rental. It is truly attainable if you plan it correctly. The qualifications for a short-term rental, there's really three main criteria that you have to hit in order to make this non-passive. The first one is the average length of stay to be defined as a short-term rental must be 7 days or less for the entire year. And that's for the entire property. So if you have like a duplex or a triplex, multifamily housing, that's you can't have a long-term tenant in one unit and short-term the other unit and expect it to qualify for the short-term loophole. It has to be the whole property. The second criteria is personal use days. You can't use the property personally for more than a greater of 14 days or 10% of the days you actually rent it out in the year. You working on the property doesn't count as a personal day. You being there to set up the property or maintain the property, repair the property, do anything regarding running the business is not considered personal. It's strictly days for enjoyment that you're there and not doing any work. And then the third criteria is material participation. And that might look different for everybody. But in order to qualify as a material participant, there's 7 ways you can do that. There's one of 7, you have to pass one of 7 tests, but we really only focus on 2 of them. And those 2 tests, the reason we focus on those 2 is because they're only 2 that have quantitative measures, goals that you can actually plan out and hit and document. The rest are very subjective, much more difficult to defend in an audit. So we really target these 2. And the first one is spending 500 hours during the year. And that's it. That's a lot. That's a lot. That works out to be about 10 hours a week if you're doing it the entire year. So if you have one short-term rental property, it's really difficult to hit 500 hours unless you yourself are doing a ton of renovation or repair work. And when we have people with full-time positions, that's not usually the test we target. The second one that we typically target is 100 hours for the year, which is much more attainable. But the caveat is that you have to spend more than anybody else, more time than anybody else. Non-owners or other owners, whoever, anybody who spends time on the property. So it adds an additional burden to you that you have to track other people's time, like cleaners and potentially contractors. And if you have a property manager or a co-host, that'll make it difficult. So it's important that you self-manage and at least in that first year and do a lot of the work yourself and rack up as many hours as you can. One of the biggest benefits of material participation that isn't often talked about when you see this strategy being discussed or in marketing materials, or you might see this on social media, but material participation for short-term rentals, you can actually combine, if you're married, you can combine both spouses' hours to attain the 100 hours. So if you're both doing the same exact thing at the same time, you can't duplicate those hours. But if you're both on the property doing different things, you're spending 5 hours at the property and each of you are doing different things while you're there, that's 10 hours that you can knock out in a day. So it makes it much easier to attain that, especially towards the end of the year. That's not the case for reps. For real estate professional, it has to be one person. You can't combine hours. It has to be just one spouse. If you're married, that has to do all 750. So it is a much, much more lenient and easier. I shouldn't say lenient because in an audit, it's just as stringent. You're going to need just as much documentation and just as much substantiation, but it's much more easily attainable to hit that as someone who works part-time or full-time, or even somebody who is unemployed currently. It's still much easier criteria.
Now that we've kind of talked about both of those, very fascinating strategies, it brings me to the question I'm most excited about. What do you think the impact is going to be on tax policy as far as having a Republican president in power?
Not only a Republican president, Republican Senate and House too. So, I mean, it's tough to say. You'll see a lot of times, during the election, both parties spewing a lot of information about what they are or aren't going to do to tax policy and any other policy. So we try not to get too deep into the weeds in the beginning. This is the part where we really start to sink our teeth in and see when the dust settles, what's really being discussed. This is a very interesting election cycle because every 4 years you're going to have some kind of notice of potential tax changes that are coming our way. But In this election, we have several tax laws and provisions that are set to expire halfway through the term. So when Trump was last in office, he passed the Tax Cuts and Jobs Act in 2017, which was a huge overhaul, the biggest overhaul of the tax code since 1986. And a big chunk of those tax law changes will be expiring in 2026, in 2 years. So whether something is changed or not changed with the current administration, there still will be a big change in 2026 because some things will either expire or they'll continue permanently or at least for a longer period of time. So even if nothing is done, there's still going to be changes, but we know that there's going to be still some proposed changes and see what happens. And I think the first one and most relevant one for us to discuss is bonus depreciation. For those of you that may know, there was an attempt early last year, to reinstate bonus depreciation retroactively to 2023 all the way through to 2025, reinstate 100% bonus depreciation. It made its way through the House very easily. It was a bipartisan bill, and it got stalled and ultimately died in the Senate. And it wasn't because of the bonus depreciation. It was because there was a child tax credit proposed child tax credit change that the Republican Party didn't favor, and it didn't make its way past the Senate. Now that the Republicans control the House, the Senate, and the presidency, I don't see something like that being an issue. I just don't know where bonus depreciation lies on the priority list now that it's an election year, and it's a new presidency next year. So I don't know how far up that will be on the priority list. It doesn't deserve its own bill, so they might just attach it to something that does have higher priority. I mean, we'll see. It's also equally important to discuss what won't be happening. Democratic Party you've heard ideas about taxing unrealized capital gains and limiting or extinguishing 1031 exchanges and other taking some advantages away from real estate investors. That won't. I didn't think that would happen if Democrats were in office anyway, but we can guarantee that won't happen now.
Absolutely. On the topic of 1031 exchanges, Nick, there are some unique situations where someone may not need to do a 1031 exchange, and this applies to our investors invest in syndications and investors who are investing out of syndications, direct ownership of real estate. Can we touch upon that briefly? We've had the lazy 1031 for a while now. What are the other scenarios where someone does not need to think about a 1031 exchange?
There's a few examples. The most common and most, I guess, direct example is if you're selling if these are passive properties and you're selling, like a long-term or mid-term rental or even a short-term rental that you're not materially participating in anymore, anything that creates a passive gain. Because if you're holding a passive portfolio and you have income over 150, chances are you have a nice bucket of suspended passive losses that you haven't been able to use for as long as you've held these investments. So a lot of times we see people sell property and it creates a passive gain and they have a mountain of suspended passive losses that have to go somewhere. And this is the perfect excuse to use them.
Yeah.
So in that case, you have a gain that you might not even pay tax on. You don't need a 1031. Other scenarios is if, like you said, lazy 1031, if you just don't want the pressure of abiding by 1031 timelines, the 45-day identification date, 180-day close date, and you're early enough in the year. If you sell a property early in the year, you may just decide I'll sell this property outright, buy a property before the end of the year, repeat the process with the cost seg, and defer the gain as individual transactions and separate transactions. Another one is if you do a cost seg on a property. If you're selling a property that you've done a cost segregation on, it makes a 1031 exchange difficult. And this is very complex and it's situational. So I don't know how in the weeds we'll get here, but basically when you do a cost segregation, you're separating a portion of the purchase price into different components and different buckets of assets and how they're classified. And one of those buckets is 5-year property, which is 5-year assets, which is considered personal property by the tax code. And that's not eligible for 1031 exchange. And there's safe harbor thresholds and rules. And again, very technical and complex topics. But if you have a property where you've done a cost seg and you're considering a 1031 exchange, you must talk with the CPA because there can be some real negative tax consequences if you go through with the exchange and seek guidance afterwards. It has to be done beforehand. So that's probably the biggest, I guess, red alert item is if you have a property that you did a cost seg on. But yeah, I mean, that's one of the beauties of real estate is flexibility on exit.
Absolutely. And you brought up such valid points. And you talked about this in the beginning where you said some of the tax efficiencies that real estate investors get are tax-free cash flow, getting that cash out refinance, all of that equity, you can tap into that tax-free at any point. And then the 1031 exchange where you can keep buying larger properties and, leveraging up by doing a 1031 exchange and deferring having to pay capital gains and depreciation recapture. But what you said, there are so many ways to play around with it where you could do a lazy 1031. You may be able to use suspended passive losses, which is why it's always important to tax plan. And I tell this to our coaching students and also to our investors in syndications, because I say when you get to exit, that's a good time to have a conversation with your CPA. So you know what your options are, and you may have more options than you think. You may not always need to participate in 1031. So very valid point over there. And so my second favorite question for today is going to be, a lot of us, I mean, we have, what is it? 45 days to the end of the year at this point.
Crazy.
And a lot of people on here are landlords. So do you have any year-end power tax strategies that people can tap into, what they should be thinking about as we're heading into the last few weeks of the year?
This is why I love tax planning, because this conversation looks different for everybody. I heard you mention at the beginning that there are some people who are closing currently or some people who are in contract.
Yep.
If you're in that group and you're about to close this close to the end of the year and you're targeting the short-term rental strategy, there's a lot of work ahead of you. It's very doable, but that group of investors really needs to understand the requirements to make the most out of these next 45 days or 30 days, or maybe even less than that when you actually close on the property. There's a lot that has to be done. So right now, the bulk of my time at the end of the year currently is having these conversations with investors in the same boat. When's the close date? When can you get in there? How soon can you get everything done? When can you get a guest in there? Are you tracking this? Do you have an accounting system set up? These are all questions I'm firing at them because I want them to be prepared, and I want you guys to be prepared too. So year-end strategies for somebody in that position, it'll be very hectic. It'll be a very hectic month and a half. But the juice is worth the squeeze. People who have already had properties, maybe you have a longer runway and you're well on track to hit your material participation, or if it's passive, maybe not the pressure to do that this year. And you just have, again, like we talked about, tax-free cash flow coming in and don't really need year-end tax strategy because the investment itself is already tax advantage and potentially tax-free. So it really depends. Business owners is like we said, 1099, self-employed individuals. There's other strategies that we talk about, accelerating expenses and funding retirement. And you have an S corp, making sure you're taking advantage of your home office and accountable plan and Section 280A rent deduction and all of these things that we want to put in place before the end of the year, because once January 1st hits, 98% of the strategy goes away. Yeah. You can't do much. You can't rewrite history. So once the year ends, we don't have much at our disposal to be able to reduce taxes. And that's something that we hear, unfortunately, too often when we get to tax prep. Is there anything that can be done to lower this balance due? Is there anything I can do to reduce my taxes now? And the answer at that point is usually no. So we really focus on proactive advisory throughout the year. And when we get to the end of the year, we look really closely at the individual's tax situation and their goals, make some recommendations, but still enough time to get some stuff done. If people are looking for an investment now, we make recommendations too on what types of investments will reduce your taxes. And it doesn't always mean real estate, but we're conscious of the time of year and what's necessary to have happen in the next 45 days and what's realistic and what we could again defend in an audit. That's the most important thing. So again, that looks different for everyone, but there are options out there.
Yeah, such valid points. I know you kind of compressed everything because I feel like you could have deep dived into each one of those things that you mentioned, especially when you talk business owners. I have the same problem. And like you said, if for passive investors, we don't know what's going to happen with bonus depreciation. And so if you are looking to tap into 60% bonus depreciation, lock in those higher passive losses, we still have a few opportunities as far as syndication. So get in touch with the team, gwcapital.com. But I want you to talk about business vehicle deductions, Nick. And if someone's thinking about that and they want to, purchase something, how does that work with Section 179 and the bonus depreciation come into play there at all? And is it easier to meet criteria end of the year, and does it affect things at all?
Yeah, so business vehicle is a great year-end strategy, and that's one of the strategies we recommend is looking to buy a vehicle, not only for your business, but you can also do the same exact strategy that we're going to talk about to make the vehicle itself its own business, renting out a vehicle, like using Turo for vehicles like you would Airbnb for a short-term rental. You can make the vehicle itself a business. You don't need to you can be a W-2 employee and still have a business use of a vehicle if you make the vehicle itself the rental business. So this is a good year-end tax strategy because it's much easier to go buy a car than it is to go buy a house. So you still need to materially participate to make that work. But if you're going to attach it to a business that you already own, if you're a business owner, you can buy a business vehicle. It has to qualify for bonus depreciation or Section 179. So in basic terms, that means it has to be over 6,000 pounds. If you're going to buy a pickup truck, the bed length also has to be over 6 feet. So there are criteria that you have to make sure you're buying the correct vehicle. You can't buy just any vehicle and expect it to be bonus depreciable. But if it meets those criteria, you have to make sure you use the car at least 50% of the time for business based on mileage. So you have to track your mileage. In that first year, when you're eligible for bonus depreciation, because you're only eligible for bonus depreciation that first year. Obviously, we want to see you use it as much for business as possible. The catch here is that you have to use it for over 50% of the time business use for 5 years. Otherwise, if you dip below 50%, you can recapture some of the depreciation that you took in a previous year. So buying a vehicle now at this point, using it for business this month and a half, and then converting it to your primary vehicle won't work. You have to genuinely have a business vehicle. So you mentioned a good question about Section 179 versus bonus depreciation. Section 179 allows you to write off 100% of the vehicle, assuming it meets those criteria. Bonus depreciation this year, as we talked about, it's the same as on a vehicle as it is for any other bonus depreciable property. It's 60% this year. So on the face of it, it looks like you would get more doing 179, but it really depends on the business. Section 179 only allows you to write off an amount equal to the amount of net income. So if you have a business that earns $10,000 net income, like $100,000 gross income, $90,000 of expenses, and your net income is $10K, and you buy a vehicle worth $40,000 and you do 179, you're only going to get a $10,000 write-off. It can only bring you to zero. Mm-hmm. Bonus depreciation can create a loss. So in certain instances, bonus depreciation, even though the deduction might be less percentage-wise on the total cost of the vehicle, you might be able to get more tax benefit because it can create a deductible loss that you can use to offset other income. So again, situational, depends on your situation, your business's income, but both are available to you. It's just a matter of which one's the better option.
Awesome. I mean, that's so valuable. I'm hoping everyone's taking notes over here. Nick, thank you so much for doing this. I feel like the year-end tax strategy is going to be super helpful. There are a lot of people who are thinking short-term rentals, but also business owners and real estate investors are technically business owners, so they get to take a lot of those deductions for their business. And so this, I'm sure, is super helpful.
Absolutely.
For all of them. And we have a link in the show notes for those of you trying to get in touch with Nick. This is going to be on YouTube, Facebook, and in the chats also. Again, I've used Nick and his team for a few years now, and I ask tons of questions. It's always back and forth. So I love someone who is working with me, and I think that's the best part. I really appreciate this so much. Thank you, Nick.
My pleasure. Thank you for having me.
Take care.
All right,
Nice
sounds
talking.
good. Thank you, guys.